discuss the market and the way forward. Joining us today, Prateek Agrawal, MD and CEO at Motilal Oswal AMC, joining in on the show right now. Prateek, hi, morning. Good to have you on the show. And I can't help but talk about banks first. And what a big bounty coming in from the central bank. There's clearly been a change in stance of the regulator and now more favorable towards banks than ever before. Do you think the banking sector will continue to be charged up even though some of these stocks are already sitting at 52-week highs?
No, yes, because of a lot of regulatory action in their favor, banks have been able to cut deposit rates very sharply, while the transmission on the lending side is yet to happen to its fullest, which means the NIM concerns which investors had have been pushed deeper into the future or maybe taken care of. That's a positive. I think a lot of that is getting built into prices. But once it happens, banks, take any bank, the best would probably expand loan book by 12 to 13%, just in line with the nominal growth of the economy, maybe a percent higher. Uh, and the flow down would be similar unless the cost to income is really taken care of. So the line to really look forward, focus on is cost to income of banks. If it is under control, then the profit increase would be higher than that 12-13% loan increase in a secular manner. I think for that kind of growth, most of the banks are looking priced, frankly, to us. Whatever the regulator has done benefits financials, benefits banks, yes, but maybe benefits NBFCs more. And then if the lending happens, maybe benefits the industrials even more.
Right. Good morning, Prateek. This is Shell also joining in the conversation. I just wanted to get your view actually on the entire metal space. We've been waiting for that safeguard duty. You know that the DGTR had given a recommendation. Now you have the approval coming in from ministry, 12% safeguard duty on certain imports, steel imports coming in. Do you think now is the time to actually adopt that sort of a strategy of buy on rumor, sell on news when it comes to the metal space? Because this one also has seen a very good, sharp recovery with the rest of the market and rest of the sector.
We agree. So today the thought is China plus one. So it's reverse globalization which is going on. Every industry, every country is able to provide slightly better field to its own domestic companies, and steel is a beneficiary. But if you look at steel and you look at the government game plan from wherever we are, we hope to get to 300 million tons over the next decade or so. That gives you a particular CAGR for the same China plus one industrial kind of thought. If you look at some of the newer spaces, the CAGR growth may be way higher. So, we are growth invested. We are focused on higher growth spaces.
And what's looking like higher growth to you, Prateek? Prateek, what sectors or pockets in the market have you identified as high growth?
Lots renewables to start with. Defense would be long period secular growth story. Industrial ex of railways should do very well. More focused on the power side. I think as interest rates drop, housing should start to do much better. It benefits industrials also. NBFCs do very well. And capital market companies from the low base, even AMCs have suffered in the first quarter, as have brokers. But from the low base, as we go ahead, there should be growth which is delivered. So these are some top of the mind sectors.
Prateek, hi, good morning. This is Shrishti also joining in. But help us understand which sectors to stay away from in this particular market, because since the start of this particular year, a lot has changed. If we look at the small and mid end of the market, they have seen a fair bit of a correction. So if you can highlight some sectors that you are not bullish on and advise investors to stay away.
Well, surprisingly, lot of the large caps are looking old. If I just put it in the context of a human being age, they did very well. They had their time under the sun, but now they are getting old. So we are very different from others. We don't think large caps are safe, etc., etc. We go where there is growth. So if you look at our portfolios, yes, we have large caps, but our large caps are super high on growth companies. They happen to be large caps. We go where there is growth. Now, the story of India is, legacy businesses and newer businesses, many of which may have come into the market over the past 5-6 years, where both the quantum of growth and longevity of growth is very different from what an index is providing. Now, so for example, in our house, you will find very little of large cap software. You will find practically very little, let me say, of steel, very little, if not zero, of cement. Okay, so you get the drift. Old legacy businesses where growth will be plus minus nominal growth of the economy. If you buy and hold for a period of time, very difficult to generate alpha after cost. For us, we want spaces where growth in earnings is fast, so that even after valuation correction, after fees, cost, yet there is enough left for alpha generation for our investors.
Right. Prateek, I wanted to get your view. You did say that you are looking at areas where it is newer themes that you are looking at, and I believe that you are liking the EMS and renewables sector as well. And the talk right now is the fact that given the fact that you have this uncertainty globally, so it is best avoided or best not to look at the companies that have exposure when you talk about the exports or global exposure. Rather look at domestic oriented counters or sectors which have more emphasis or more business when you talk about back home. So are you also liking that sort of a theme right now?
So yes, so today EMS for us is domestic focus because a lot of what they are doing is import substitution. In that manner, they are defensive, aggressive, if I can put it that way. So today, defensive, very little export orientation to any of the listed names, frankly. And tomorrow, given the China plus one on China, and today, Chinese satellites plus one kind of thought that is going on, they can have opportunities which otherwise may have been very difficult to get. So, whatever Indian policy may have done for Make in India, the makeup of the world today could possibly do much more. Hopefully, as a country, we grasp this opportunity with both hands.
All right, Prateek, the other factor that we have been tracking is the dollar index, because of late a lot of volatility in the emerging markets kicked in because of the surge in the dollar index. But in the last 2 weeks, we have seen a share bit of a cool off there, and help us understand then in the past when we have seen such bit of a rebound, how the emerging markets and especially what was in the store for the Indian markets and how are we likely to react?
So, drop in dollar index indicates improvement in sentiment towards emerging markets. So that is one. Drop in dollar index indicates money moving away from, let's say, the US to other markets. So US performs in one manner. It's a very large market, so it is not point to point, but it performs in one manner. The rest of the world may end up doing better. weaker dollar, which is also the direction of their policy, at least one of the stated objectives, historically has been very positive for emerging markets. So lot of things are positive. Lower crude is very positive India. In fact, whatever slowdown the world may experience on account of duties, etc., we more than make it up with lower crude prices. Now, there is one indicator which is not looking too good, which is US bond yields. Now, US bond yields are high. They are stabilizing at a high level, not coming down, while again the policy stated direction is to bring them down. When that happens, yield-seeking investors, so a lot of foreigners, FPIs are actually seeking arbitrage opportunities in India. Once you net off the rupee depreciation from the equation, today those guys would be looking at US market only, the bond markets there, they are getting very good yields. So if the yields start to move down, then even more positive. But as such, today we are pretty good. Just look at it. If the two large economies of the world want to disengage at least a bit, and that's the direction they want to go into, it is but natural that the financial markets would also disengage. Okay, from both sides. EU is very, very policy focused, right? And they would also take steps to safeguard longevity of their well-being, right? That puts India, which today is seen as a neutral country to everybody, third or the fourth largest market globally. We have lots to look forward to. We would be wooed by everybody thinks that we were probably not able to get in the past, we could get in the future. There's a great chance of that happening. You are looking at least that's what the newspapers tell us, a deal with UK, with EU, with US. Now, those are expensive markets. There, what we manufacture low cost should find much better acceptance versus, let's say, an ASEAN kind of an FTA to our mind. And, if we get these FTAs done on terms which are favorable to us, more to look forward to. And the reverse thing is, what do we do? What can we export? And those from there we will generate newer growth themes for the future.
Okay, Prateek, so good having you on the show today and getting, diverse views from you on not just the sectors, but really what's happening across the global markets too.
Thanks.